Aarti Seth, Vice President, Sovereign Risk Group with Moody's Investor Service. She joins us live from, not live, she joins us from New York. Aarti, good morning. Thank you for joining us. Aarti, Reserve Bank of India still remains cautious on the WPI inflation, food inflation and high current account deficit. Do you think Reserve Bank of India and its role is considerably justified to cut rates by 25 bips? And does a 25 bips rate cut meet your expectations?
The RBI's role is to balance the trends in growth, which justify monetary easing, against the trends in inflation, which, while non-food inflation is going down, we expect food and fuel inflation to remain fairly high. So balancing these two trends, the RBI has chosen to ease monetary conditions so that growth can revive, but to do it cautiously. So I think the 25 basis point reduction is exactly that. It's a cautious reduction in monetary policy rate.
Aarti, hi, morning. RBI has acknowledged growth risks, but still states that it has limited room for monetary easing. What do you expect from the RBI in terms of repo and CRR rate cuts going forward?
I think in terms of room for monetary easing, what the RBI is referring to is not just the inflation trends, which we know that, food and fuel, there's nothing much the RBI can do about, but fiscal trends as well as trends on the supply side. I think if the RBI felt comfortable that the government would not pursue loose fiscal policies as it has in the past, and I think the recent budget did give them some comfort in this regard. But secondly, now turning away from fiscal and inflation is the fact that India's economy remains supply constrained. So if the RBI were to ease rates, the RBI knows that that would fuel demand growth. But unless there's a supply response, this demand growth would become inflationary very quickly. So I think the next thing that the RBI is waiting for is to see that the supply constraints, particularly in the areas of investment and infrastructure growth, are eased so that there can be a supply response when demand does indeed accelerate.
In your report, you mentioned that food demand is unlikely to fall and food supply is difficult to raise. Given the current scenario, what do you think government can do over the next 6 months to address and implement supply side measures?
I think 6 months is a very short time period to implement anything, but it's very clear that agricultural productivity in India is below that of the average around the world. And here's an opportunity, because if you simply improved agricultural productivity in India, you would have a lot more food output, and that would resolve your problem without having to import or expand the land that you have under agriculture. Rural infrastructure is one constraint on agricultural productivity. The transport, the storage, the distribution systems are another constraint on agricultural productivity and output. So I think these are some of the constraints that the policy can address, and that doesn't necessarily have to be done at the central government level. It can be done at the state government level as well. It can be undertaken via private initiative as long as the regulatory policy around that private initiative is facilitative. So I think it's not just up to the central government to increase agricultural productivity. It can be done at different levels of government. It can be done by the private sector. But central government policy has to be facilitative for all of these actions to take place.
But the RBI, Aarti, has mentioned that risks due to current account deficit do remain. However, post the fourth quarter, current account deficit is likely to, to improve a bit. What is your view on the same?
Certainly that, there were factors that particularly impinged upon the current account deficit in 2012. We've talked about oil prices remaining relatively high, but also gold demand in India, and that tended to shoot up despite rising prices. There was also global growth. Global growth was quite subdued, and that meant that export growth was less than had been anticipated earlier. I think all of these factors to some extent will come off in 2013. Global growth is expected to pick up, albeit slowly. Oil prices, while not expected to fall, are certainly not expected to rise. And given how much gold has already been imported into the country, it looks like recent trends suggest that we won't see a similar rise in gold imports over the next year. So I think that will help the current account deficit to some extent.
Atsi, what are your thoughts on India's current political scenario since we are approaching election towards 2014? How would you view, what is your view on India in the scenario of change in government or a non-stable government?
From our perspective, governments in all countries can change given the democratic process in that country. So it's not the timing of an electoral change, whether it's done earlier or not, but what impact that electoral change has on the economy and specifically the credit profile. So certainly what we'd be looking for is what are the policies pre-election? What are the likely policies post-elections? How is the market going to respond to this? What are investors going to do as a response to electoral changes? And in India, I think most people are familiar with political volatility from time to time. So I don't think that the prospect of early elections necessarily means that private sector activity ceases, etc. But I think that what we'll really be watching for is what it will mean for policy, because we are at a critical juncture in terms of policy expectations on the part of the population. People do expect further reforms from the government. People do expect implementation of already announced reforms. If the political cycle somehow put a brake on those things, that would be credit negative. But if reforms and particularly implementation of already announced reforms continued, then it would be neutral from a rating perspective.
Atsi, so under what circumstances would you revise your rating and outlook on India?
We are always monitoring India's rating and India's credit profile. So even if there isn't a change in the government, we will be looking at the credit profile. But what we'll be watching for is not necessarily just who wins or what the composition of the coalition is, but what are the likely economic policy announcements. And, we would look at India's rating from that perspective. If we find that the policy announcements are credit negative, that would certainly make us reconsider the rating. But if the policy announcements tend to be credit neutral or credit policy positive, that wouldn't necessarily affect the rating profile.
Right, Atsi, appreciate your time and thank you for your insight.